What a joy it is to be at the Bloomberg Invest Summit. Myself, Caroline Hyde of Bloomberg Television, joined by a man who really needs no introduction. You know him, John Rogers, of course. A man who is a legendary investor, but notably a value investor, having loved growth stocks for only a couple of years. I mean, when he was busy on the basketballs, the courts of Princeton and going across the campus to go and put on stock trades, he moved from growth into value very swiftly and has now, well, been managing up to $16 billion in that global asset management firm that is Ariel Investments, which he set up at the age of 24. Extraordinary, John. It is wonderful to be joined by you now on what is almost the 35th anniversary of your main fund, flagship fund, Ariel Investment Fund. And as one of the only sort of length of tenure out there for mid-cap value funds, at this juncture, how do you feel? How do you feel about the market, about valuations, about volatility?
I think the market is in sort of two different places. I think that the S&P 500 that is so dominated by large growth stocks is very, very expensive on a historic basis. So I'm not surprised to see this most recent retreat and correction that we've been going through. But the small and mid-cap value sector is still, I think, significantly undervalued. There's a lot of bargains out there, a lot of orphans that have been kind of left for dead that no one cares about. So it really is a tale of two markets. The large growth stocks are expensive, but the small, mid-sized, undervalued securities are real opportunities there.
Just give us, first and foremost, your distinction of what a value stock is right now. John, can you hear me? Oh, we're just having a pause, a slight technical issue. We'll wait for him to come back online as a man who can help describe exactly what a value stock really means. There's much debate, and of course, many know that to a certain extent, the S&P 500 at the moment, we're seeing growth and value stocks basically at parity. We're seeing value stocks up about 15, 16%, growth stocks up to a similar degree. And remember, of course, it was value stocks that were actually outperforming at the start of the year. I think we've got him back online, John, and great to be with you. I just wanted to know what you thought a value stock was at this moment. Define.
Well, what's always looked to is to, we've been very, very influenced by the world's greatest investor, Warren Buffett. We're always looking for the stocks that are statistically cheap, selling at low price to EBITDA multiples, low price earnings multiples on a historic basis. And ultimately, in the end of the day, we want to find companies that are at least selling at a 40% discount to their private market value.
Okay, so when you then are focusing in on small and mid cap, is size a distinguishing factor when it comes to value from your perspective, or is it just feel that that's the area of opportunity where people are overlooking because you have to get more nitty gritty?
Well, I think that there is more opportunity in the smaller stocks for sure. When I started in this career 38 years ago, there were so many analysts following the small stocks, and people talked about the blue chip stocks kind of being blue chips because they weren't going to be able to grow as fast. They were going to have, just lack of opportunity because they're more efficiently priced. But today, so many people just fallen in love with growth stocks, fallen in love with chasing the hot stocks of the day, the meme stocks, the fast-growing companies. They're just leaving these small, undervalued securities just totally neglected. I call them orphans. And so there's just this real opportunity that I've really never seen before, where you've seen such a dichotomy between different sectors of the marketplace. It's so dramatic. Now, I do feel that the higher interest rates that are starting to come in are really going to impact large cap growth stocks significantly, because they've been able to make a case that they're undervalued if interest rates stay incredibly low.
Is it interest rates that are the risk here, or is it inflation? We're seeing notes put out by Citigroup's chief global equity strategist today saying, look, get into financials. That's where you can protect yourself. We're not talking about absolute growth, but we're talking about a level of protection against inflation. Is that an area that you're worried about, or is it interest rates that really you need to be honing in on?
I think interest rates are the thing you have to be honing in on, but of course they're tied directly to inflation. If we continue to have this really steady increase in inflation, you're going to see a steady increase in interest rates. And then when you do the discounted cash flow analysis on future earnings, those companies that are dependent on earnings coming 5, 10 years into the future, they're going to find their stock prices squeezed because of these higher interest rates. But we have tried to concentrate more in areas that we think will benefit from inflation. And whether it's real estate related companies or financial services companies you suggest. We think there are some real bargains there that will benefit from higher rates. Probably our favorite is in the banking industry is Northern Trust. It's this iconic brand here in Chicago, great management team. And as interest rates go higher, they will be able to really be a prime beneficiary of that movement.
I want to go back to what you were just saying, and you saying about of Chicago, and I think back to you growing up and a man who was ahead of, you at a very young age were into stock picking. Your father had helped bring that to bear, gifting at certain birthdays and Christmas. But you fell in love with growth stocks to begin with, and you say now people are falling in love with them too much. Now, is there an element that's the gateway to falling in love with the stock market in general? Should people be excited about the bright new thing initially, and then as you become more experienced and understand that actually you need to be a little bit contrarian to win out in this market, therefore you then start to look at other opportunities?
It's interesting, interesting question. I think for me, fortunately, when I was at Princeton, Burt Malkiel had just written A Random Walk Down Wall Street. And he did a great job in that book, not only talking about efficient markets and how hard it is to outperform, but he shows you some of the great bubbles that occurred and the dangers in falling in love with the hottest new theme of the moment. And, whether it's a tulip bulb fantasy or what happened in the Roaring '20s, et cetera, et cetera. So I think one of the things I think is unfortunate is that if you don't learn early enough to maybe get away from chasing the hot new thing, when you get burned, you will be reluctant to get back into the markets. So that's what I worry about. So many people who got swept up in the internet bubble, basically swore off investing in stocks for a long, long time. And so I hate to see young investors, new investors getting into these meme stocks, chasing quick profits on Robinhood. I worry that they might scar them and discourage them from participating in the market for the long run.
And particularly when I know you're a man who has so focused on diversity from the very off. That's how you met your partner in crime. And of course, the person that's helped build Ariel Investments was through trying to bring more diverse people of color, diverse backgrounds into the University of Princeton. And it's something you followed throughout your career. Are you hopeful by new opportunities to invest, whether it be Robinhood, whether it be sort of the fact that we have to pay no fees to trade stocks, that we are able to build wealth among a greater proportion of people? Are you excited that people are getting into the market? But hopefully we need more, is it financial literacy to ensure that they're not getting in and getting burned?
Yeah, I think financial literacy is key, and it's really, really important. As you know, 25 years ago or so, former Secretary of Education Arne Duncan and his sister and I created a small public school called the Ariel Community Academy. And the idea was that every first grade class would get a $20,000 class gift, watch us manage it through our funds for the first 6 years, along with John Naveen. And then in 6th, 7th, and 8th grade, the kids would start to pick real stocks with real money and benefit from their own stock selection and learn about financial services careers by visiting with our analysts and talking to our analysts about how to do research on individual companies. So when I had a chance to chair council for President Obama on financial literacy, the recommendation we gave the president was to encourage all financial services companies to partner with urban public schools and get young people, women, people of color exposed to the markets at an early age and get them comfortable. So when they get out of college, they've had a chance to have experienced real life investing. And so we think that's just so important. We've got to get our public schools focused on financial education, learning about the stock market, the magic of compound interest. And that was one of the beauties of our program is the kids got to see money grow over 8 years and see that real benefit of how time helps you as all inevitable ups and downs occur, but the markets trend higher over time.
And to that, and therefore you're looking at financial literacy, you're understanding a way of trying to build that momentum and hopefully that brought to bear actually the partnership that we see. But are you worried about us being in a bubble right here, right now, which might burn others? You talk about sort of the worries of after the internet bubble. Are we in a bubble now, John?
I think parts of the marketplace are in a bubble. I do, and I've said, it's not only the meme stocks and the hot growth stocks that have done well, but of course it's the cryptocurrencies. Everywhere I go, whether it's I'm in an Uber car or whether I'm in a Lyft or something, even my favorite pizza place, the delivery guy wants to talk about cryptocurrencies. And that's a sign when everybody who's not an expert in the field is like, I want to get in here. And all my friends have told me how I can get rich quick in this. that is a real sign that you're at the top of a bubble. And so there's certain sectors that are very, very worrisome.
I mean, at this exact moment, just as you were putting those thoughts to bear, an audience question came in saying, does Ariel itself have exposure to cryptocurrencies? I mean, Ben Miller, another value investor, he's saying he loves Bitcoin. Are you exposed, or is this just not a game for you?
It's not a game for us at all. It's sort of interesting. Bill Miller is a great friend, and we have a lot of respect for each other. We share stock ideas and talk to each other regularly. But this is just an area where we have a agree to disagree, and I'm very cautious. I know Charlie Munger, of course, has been very vocal about this, and people like Jamie Dimon and others have been pretty cautious. So I think it's a time to be cautious.
Why? What is it that puts you off?
Well, as Warren often says, commodities, like if you buy gold, it doesn't produce anything. He jokes around, you can go and shine it, and you can look at it, you can study it, but it's not like a farm that produces corn or whatever it happens to be, or some other manufacturing plant that produces all kinds of goods and services that can benefit mankind. So that's the same thing, I think, that when we think about something like cryptocurrencies, there's no real economic benefit that comes from it that we can see. It's just another commodity. It's such a volatile commodity that we can't quite figure out how you would use it to buy and sell things when you could have this currency moving in such dramatic ways. And I think our financial systems worked very well for, over 100 years. I don't think it's time for us to try to have a brand new one.
Okay, so it's not a question of regulation. I'm not going to stick with crypto too much, but there's audience questions coming in thick and fast on it. But would DeFi be more of interest because they are protocols that are growing something different, or is it an element of regulation that would ever take you there, or really it's just the element that this isn't your contrarian idea, this isn't value investing?
Well, certainly not a contrarian idea, that's for sure. So it would be very hard for us to get interested as an investor. I watched Ken Griffin, who's one of our outstanding investors here in Illinois and nationally, founder of Citadel, and he was talking about this for an economic club conference this week, and just saying the regulation would help. Because then they would be able to trade it and be able to do that effectively. So I think regulation is important. You just can't be the wild, wild west out there with currencies, and you've seen China has been very, very negative on it. So I know Gary Gensler is focused on this. He's an outstanding SEC chairman, so I'm confident he will come up with a program that will help, and maybe that will lessen the volatility, and maybe it won't be as easy to trade, but it'll be something that you should have more certainty around it once you have the regulations in place.
And as our own dear Eric Schatzker, who's in conversation with Ken Griffin at the Chicago economic discussion there, and I'm interested in, it was sort of Eric was discussing yesterday what was coming out of the Bloomberg Invest Global Summit was this view that actually now is the right time to sell. We were hearing it from authorities over at Blackstone, voices that came from Brookfield Asset Management. Is now the right time to also take profit, to liquidate amid a liquid market, or is now the time really to buy and keep on buying any dips that we see?
I think you can buy the dips in the parts of the marketplace where there are bargains, and I do feel, as we've talked about our small and mid-sized favorite companies like Madison Square Garden Entertainment is one of our favorites, that they own the Madison Square Garden in part of New York City. We love Lazard. Ken Griffin is a terrific CEO there, and all the deals happening around the world. Lazard is in the midst of many of them, and being a global franchise in investment banking and also in the money management international sector. So that's another financial services company we believe in. KKR has been a holding for us for a long, long time. And so we think private equity is going to continue to grow and thrive. And Henry Kravitz is still in the saddle, helping drive that company. So there are opportunities. And one other area beside, the garden itself, the sports related teams. We think a lot of the sports teams are cheap. When you start to think about how you can use those assets, the personalities of the players, the brands of the teams globally. So Manchester United has been very weak lately. We think there's bargains there. It's international soccer brand and really a true global enterprise. Madison Square Garden Sports is something that we think is great, that they own the Knicks and the Rangers, And and sports teams are going to be able to, again, be more and more global, be able to use their brands and their extraordinary athletes to generate more and more revenue, and people want to watch these games throughout the world. So there's real opportunity, and of course, with all the money coming from the gambling side, with FanDuel, et cetera, that makes these sports franchises worth much more, and they seem to be very cheap here.
John, you were a pretty good athlete, pretty strong on the basketball court. I mean, what were you interested in sports teams? I know that you have a lot of focus on female basketball playing in Chicago. Is it something that you want to grow as an asset class for you?
Well, it is, as Warren says, you always invest in your circle of competence. And I did get a chance to play for Hall of Fame coach Pete Carril at Princeton. He spent 29 years there and 15 years as an assistant coach of the Sacramento Kings. He was a genius. He's in the Hall of Fame, and it was great. When I got there, I wanted to be a basketball coach. But when I got there, he made it clear that my basketball knowledge was not what it needed to be. And I realized I wasn't as smart as he was, so I understood a career in basketball was not possible. He kept me around the whole 4 years because I played really hard, and I got to be captain, got a chance to play for a while. But it was an extraordinary experience. So it gives me a sense that I do love basketball. I'm on the board of Nike, which I'm really proud of, and it's been great to get to be with Phil Knight, and the late John Thompson was on the board. And but finally, as you said, the women's team are fun. Being involved with the Chicago Sky has been a real blessing, and to support these dynamic women. And we're finally, I think, starting to build real momentum. The ratings are up 80% year over year in this playoffs this year. I think there's going to be a real opportunity when people see these women that is going to grow into an extraordinary success. So really excited about that, and really excited about our hometown Sky team hopefully making it to the finals.
Yeah. Even though I'm not a Chicago fan, I will be for you, and particularly about those women. But John, so you didn't have, therefore, quote unquote, the vision on the basketball team to become a coach, but what do you think made you distinct in terms of having the vision to become, such a legendary, and I don't use that lightly, value investor, to be able to build up a 16 billion in terms of assets? Like, what was it? How have you been able to see things differently, to have the longer term vision as to what wins out? Because we're saying, almost 35 years in your fund, and you always beat the benchmark.
Yeah. Well, I'm not always beat the benchmark. We're proud of the 35 years ahead of the benchmark, and also the last 1 year and 10 year. It's been a really great period for us. But it's interesting you bring up that term vision. Coach Carril said that I was legally blind when it came to basketball, and that he couldn't teach vision. One thing he couldn't teach. So I think I've been blessed that I do think I've had a vision at Ariel to, one, identify great talented people, early on, like a Melanie Hobson, who I met when she was 17, and, other talented people. The CFO at Northern Trust, Jason Tyler, I met when he was 17 and knew he was going to be a superstar. So I've had a vision around people. We have a great research group at Ariel. It's very strong, dynamic, a lot of University of Chicago Booth grads there that work with us. And then I've been able to have a little vision, I think, on which industries we're going to succeed and thrive looking out over the long run. As you know, we are long-term investors with the turtle logo, and being able to not get swept up in the emotions of the moment and the drama of the moment, but being able to see a little out beyond the horizon, and being able to buy in the midst of financial panics like 2008 and 2009, or be able to buy a year and a half ago at the height of the COVID crisis. Being able to see over that horizon, having that vision, is something that has helped our performance over the long run. A lot of our performances come in those periods when there's been dynamic change and dynamic volatility.
And you talked about that volatility being almost upon us. We've got but 1 minute, but there was an interesting audience question that came in beforehand towards you, and it's David from Greensboro, who is saying, therefore, are you a bull or bear on the overall stock market out to like 2023? Do you think we're set for downward trajectory, or will we generally go higher?
Looking out toward 2023, I think it's going to be a really tough time for the S&P 500 and the NASDAQ to be successful, but it's going to be a real wonderful time for small and mid-sized undervalued securities, sticking to those industries that have underperformed over the last 10 years or so. It's been brutal, but it's only fair that turnaround is fair play, and if you're a contrarian, these ideas will do well over the next 3 to 4 years.
And last one for you, John. You just talked about listening to Ken Griffin earlier about Chicago. You still think it's a good place to build a business?
Oh, I do. we love our city, and Melody and I, we love Chicago. We're committed to Chicago. It's the greatest city in the world, and the way the business community works together with the community, and it's something special here.